Hi, I'm Nick Bradfield and welcome to my first video newsletter. By now you should have received a written newsletter that Paula sent via email. Hopefully you've read that, and what I'm going to try and do is just explain some of the key points that have come out of that newsletter. So what are the key topics driving market sentiment at the moment? There are a few, but the main one is interest rates, and US have started to lift rates. Now, this is going to put pressure on equity markets. It's going to put some pressure on the cost of companies running their businesses, and this is just the market's way of reacting to that. And we have seen a couple of down days that reflect that sentiment. And another issue that's come up is trade barriers. That's been with us for the last few months. Donald Trump has obviously put America first, and this is going to put some inefficiencies into the market because it allows inefficient operators in the market, and markets tend to not like trade barriers. The other thing that we've got is this generally high asset prices at the moment. We've had that for a while, and part of that is because interest rates have been so low and people have been looking for other areas to put their money, and that means equity markets, bonds. People are paying a premium for these assets because they can't get the return on their cash interest. So all of these factors have probably led to this recent sell down in markets. But what we're concerned is, how is this going to affect our portfolios? Way I see it is that we are not immune to any market falls. However, I think our portfolios will hold up better than most because of a few key things we have in our portfolios and what we don't have in our portfolios as well. So on the defensive side, we have cash, not necessarily bonds, and in high interest rates going up, bonds can actually go down in value. So we're protected there, and also a few of the switches that we've been doing in the past have kept our portfolios in a good position to take advantage of any market falls. We have moved away from, say, the Magellan fund and more to the Platinum fund, you'll notice, with some of those switches we've done. In the past, we've had a lot of funds in Magellan, and that's been a great thing. Now, that is heavily invested in North America, and it's invested in a lot of the tech stocks. You'll heard them, the FANGs, which is your Facebook, Amazon, I think Netflix, Google, and the S. I can't quite remember what it is, but someone might be able to comment on that later. So we've kind of tended to go away from those stocks and more into value stocks, which is your Platinum fund managers, which don't necessarily target those sort of stocks, a value-orientated stock. The other thing we've done is moved away from bonds in the Australian sector and international sector and holding cash. Even though we know that the cash is going to return a little bit less, times like this is where we can use it to our advantage and actually use it to take opportunities if they come up in the future. And obviously in the Australian sector, what we have done is move to value over growth as well. So we'll have increased our perpetual shareholdings in your funds, which hasn't been the best performer in the past, but likely to outperform in markets like this. So where are we? I actually think that this places us in a good position to take advantage of any market fallout that we have. And the big question is whether this is just a short sell down of the markets or whether we're in for a longer downtrend in markets. If that's the case, we're prepared for that. But obviously, if you have any questions, please don't hesitate to call, and hopefully we'll catch up soon. Thank you.